It looks kind of straightforward. All the numbers roughly in line, just a little bit better than expected. The market reaction makes sense. Is this a company now that we can envision a path to profitability?
I think on the ride-sharing side, an absolute yes. And you see that in the EBITDA margins. Actually, it improved on the ride-sharing side to 24% EBITDA margin. So on a $11 billion run rate, a 24% EBITDA margins looks really healthy. The problem is on the Eats side, and they continue to lose money. And if you see the difference between bookings and revenue growth for Eats and ride-sharing, you will see in case of ride-sharing, the price increases is driving revenue growth faster than bookings growth. In case of Eats, that's not the case. And part of the reason is because Eats continued to see a lot of subsidies being deployed in the business.
Let's talk a little bit more about the ride-sharing part, because you said the pricing trajectory has gotten better. How much pricing power does Uber really have, though? Because so much of the initial growth came from subsidized rides, and of course it was competing with Lyft. Now that it's a publicly traded company, it really needs to show investors the numbers. But at some point, it's going to top out.
Well, so in this case, this was the first quarter where we know both Uber and Lyft increased prices, and it didn't have any sort of negative impact on the trip growth. So the trip growth was about 32%, steady around 30% what we have seen in previous quarters. Where you're going to see an impact is on the user growth. So that seems to be tapering a little bit. It has decelerated just about slightly than its previous quarters, north of 25%. And so you are going to see that, but those are not the kind of riders where Uber wants to invest in, because there's going to be a very little repeat rate when it comes to those kind of riders which are that price sensitive.
Got it.
So, I mean, we're hearing from Dara Khosrowshahi in the press release talking about this idea of profitable growth, not just growth at any cost, sort of that drum that so many of these tech-related companies have beat over the past. Nelson Chai saying that their focus is on disciplined capital allocation in order to meet these goals. What does that mean?
Well, so that means they're going to pull out of certain markets. They started to do that with, pulling out of Eats in India and South Korea. Those were 200 million drag on EBITDA each. And that's what you're going to see more of. I think they're going to pull back more on the Eats side.
Well, I'm curious. I want to talk more about that. On the one hand, we know that food delivery is this brutal business. Everyone's just killing each other on profits and undercutting each other, and no one seems to be making any money. Nonetheless, for Uber to really realize its potential as a company, does it need to keep playing in these markets that expands its sort of core logistics platform beyond just ride sharing? Like, does it have to, on some level, ride it out and build out new businesses?
Well, at the end of the day, Uber is a marketplace company.
Right.
With marketplace, you need scale and network effects.
Yeah.
The way you're going to garner scale and network effects is you've got a big kind of cluster of companies, or drivers, or in case of Eats, restaurants on its platform, and you really hope at some point the bundling kind of gives you that ASP growth, which you can leverage and show the operating margin and scale. But that hasn't happened yet because Eats is so unprofitable, and it's just got bad unit economics.
I just have one last question about the food delivery business. We know it's hyper competitive and everyone's trying to grab market share while they can. SoftBank, which of course is backing a lot of those players, is now coming under some pressure of its own, with Elliott Management taking a stake in the company and looking to engage with management over how to wring out more value. What does that mean for the food delivery business? What do you think that'll mean 6 months from now, a year from now?
More consolidation. And we've already started to see that in the industry with Takeaway.com buying Just Eat. There's been some consolidation in South Korea with Delivery Hero buying, the local vendor. So SoftBank, given it's got, stakes in all these companies, is probably going to force consolidation, in some way, because food delivery business, otherwise, given its low gross margin profile, is never going to get profitable at its current state.